Hello, ladies and gentlemen. Welcome back to my channel, Financial Advice. I'm Ashton. I'm down for working on these videos. I got started, I was doing a few, but I think I'm going to just be down to about once a week. I could be your weekend finance recap guy. I'm just busy with accounting and working towards my CPA at the moment. But over the past week, I've seen small growths with this channel, and I've been loving it. It's great. YouTube it's something. That's kind of how a business works too. You do something, it starts off small, and you see the snowball, and it rolls down, and it just gets bigger and bigger and bigger and bigger, and it's amazing. It truly is. Let's talk about equity, the stock market. This week, we've seen the market go down. It could be people taking the crop of their earnings. You know, they're just slimming off the top. A lot of people have been involved in the market for 10 years. Why not take a little bit out when things are just uncertain? Some people might be expecting the market to continue downwards like it did in March. People are also reacting to the spiking cases of COVID-19. States have been shutting down or pulling back a little bit. The country, not just the country, but the whole world right now is shrinking economically, about 5%. Be aware going into next week. A lot of people don't have jobs at the moment. You know, their day-to-day isn't going to be about the stock market. It's going to be, where do I go from here? And the experts expect a big turnaround by the end of this year. With investments, with financial information, you can look at past data, you can try to predict the future, but it's all fair game. Anything can happen. Recessions can last up to 4 years. That means the market goes down, stays down. We will see. I'm waiting on Q2 earnings and get an idea of what might transpire in the future. In March, April, I had many securities. I was very involved in the stock market. And then after a while, I moved everything into Apple and Amazon. Great companies to be involved in. Have their accountants count you in on the equity sheet. I did read a report. It was actually, I think, like a conference call from Jeff Bezos telling investors to sit down for a minute. That Q2 earnings, our revenue is up, but essentially the company, Amazon, is spending money, and you might see, I guess, per se, a loss. I've been monitoring the cases as well in my country, and I perceived a jump in cases. So I pulled out of securities and I moved into treasury bills, T-bills, essentially government-issued bonds. I've been fortunate that I haven't lost my shirt moving around, trying to figure out where am I going to go in this market that's moving up and down. Now I've got this short-term gain tax that I'm going to have to pay next year. Exciting. Investors that have had a mix of stocks and bonds have done really well. Bonds are generally very slow moving, and the feds are pumping cash into bonds, corporate bonds. It is a very wise decision to speak with a financial advisor in your area to get a better understanding of bonds. Bonds right now have been going up a little bit. I've been seeing about 40 cents per share increase daily for the bonds that I own. Very slow moving. You know, when I was involved with Apple and Amazon, I was seeing anywhere from $60 a day. So bonds they're still a risk, but they're relatively safe, especially government-backed bonds. Honestly, I expect more people to move into bonds in the next coming days. Gold as well. A lot of people are expecting gold to increase because a lot of people want to have a safe haven now to put their money. In this past week, there's been an outflow of $7.1 billion in equities. People have pulled money out from the stock market, and bonds have had an inflow of $19.2 billion. So this week, $19.2 billion were put into bonds. I expect in the next few days that we'll see an inflow of about $75 billion in bonds. Bonds, especially government bonds, are relatively low risk and have become attractive to investors as interest rates have fallen. When that happens, bond prices go up. A little bit of a personal note. With my age, I'm still going long with my retirement investments. Currently, I'm purchasing stocks of small, mid, and large cap companies. Currently, I spend about $370 to $500 a month towards my retirement. Of course, I'm a long way from retirement, and with the market going down, it's a great time actually to be investing into your retirement plan. A few days ago, we talked about Hertz, the car rental company. It's going bankrupt. First off, they've scrapped their issuance of stocks. They're not doing that. Secondly, news came out that Hertz might be bought out by another company or a group of companies. Now, Hertz still has high debt. They've got $1 billion in cash and they've got about $20 billion in debt. An interested company will look at their financials and decide if it's worth it. Do the numbers match up? Do we really want to take on their debt? Could we buy another company, or could we just start from the ground up? This is market share. It's gonna go away, and when the economy recovers, people need to rent cars still. It's still very unlikely that, in my opinion, a company will buy them out. Now, Robinhood, the app, you can see user data. There are about 6,000 shareholders from within the app, and they are hanging on. Experts have stated that these individuals have missed out on a good selling point. They are holding on, hands of steel. I think possibly it could be ignorance, where a situation goes so bad you don't even want to get involved or look at it. I have a rule for myself. Keep track of your investments. You don't want to leave a company because there's a little bit of bad news, but you need to be able to identify when a company could be potentially down the road a bad company to be involved in, and knowing when to pull out your investment, because either they're just not going to make a profit for a while or they could be headed towards bankruptcy. You can stop the bleeding in a sense. You just pull your money out and move on. Here's the tip for the day. Look at the debt to equity ratio. If you look up a company and you type in debt equity ratio on Google, you don't even have to do the math. It'll give you numbers. Generally, a company should be like 1.5 debt to equity. For most industries, it can vary. Some industries have a higher debt load just because of that industry, and you should compare between multiple companies. Looking at Hertz, at their debt to equity, for the last 13 years, the highest was 23.2. In March of 2020, it was 15.01. Relatively high. In a sense, you'd think, you gotta look at another company. Well, Enterprise, I know, is a privately held company. Enterprise, the car rental company. So we can't look at their information. They're not public, so they don't release their financial statements. Why should they? They don't have to. No one's investing in it. It's privately owned. So the next best option that I could find was Expedia. Okay, Expedia, the hotel booking company. And hang on a moment. They own carrentals.com. Expedia is actually very diversified in many companies. They own hotels.com. They own Travelocity. I think it's like 9. They own like 9 different companies, but they own carrentals.com. So they're in that industry, but they're more diversified. So they're better off than Hertz. Hertz is, as far as I know, is just car rentals. They just do car rentals. They don't get involved in hotels or travel or anything else. So Expedia has moved on into different industries to build up their revenue. Their debt to equity was 1.77. So 1.77 is a lot lower than 15.01. Just a little bit of insight so you can do your own analysis of a company and deciding, should I invest in this company? So guys, thank you for watching. This has been Financial Advice. Always do your own due diligence. This is all educational and basically my opinion. If you've enjoyed this video, like, subscribe, notification bell. If you've got an opinion, even if it's different from mine, leave a comment below. I'd like to hear back from you. Again, thank you for watching.